So if you are trying to add value through stock selection, once you get above 30, 35 stocks, you're pretty much owning the index, right? This classic diversified
Who can
portfolio.
keep track of 30 stocks? Give me a number lower.
Oh, goodness. Well, we have a great team that does it, and we do a lot of quantitative research that helps us choose those stocks. But what we see is that there's a big difference between the active selection within an index like the value index, which is far more diversified, versus the growth index, where the top 10 names are 55% of the index. So you have to own those concentrations just to keep pace.
Do you diversify across sectors, plural, where you have one stock in each sector? Or do you diversify within a sector that you're making a bet on?
Our preference is to be sector neutral versus the index, and then buy the best names that we identify in each sector. What that means is it keeps our what we call tracking error low, meaning that we're not taking on too much risk outside of the index. And what you find with sector relative performance is that it tends to be fairly short-lived. Outside of trending sectors like technology, you can have things like the industrials outperform for a couple months and you feel really smart, and then it reverses and gives it all back. So we prefer to stay sector neutral and then have our active selection within the individual names.
All right, I'll go with that. Earnings. We're kind of kicking off the meat of the earnings. We had the banks over the last couple of days. They seem, I don't know, pretty good.
Yeah, they're okay.
Okay, is Tom. I mean, what are you looking for in earnings season here?
Yeah, we do think that the market broadly is expecting beats and raises. That is no surprise. We came in with estimates fairly low, in low single digits. And if you look at the last quarter, when we came into the first quarter, it was 7% expected. We got 12%. So the market, the buy side whisper number is certainly for higher earnings as we move through this earnings season. So we've been arguing that it's much more interesting, the reaction to those earnings. So you get great numbers out of the banks, and then the stocks kind of go shrug because they've been pricing in a lot of this expectation for good news.
So what do you see in technology? Is the major variable there their CapEx spending and all this AI baloney?
Well, so the key here is that we know the CapEx is going to continue to be high. And what's happening within these technology companies is fascinating. Take a name like Meta, talking about hundreds of billions of dollars into CapEx for these big giga data centers. You're effectively taking a capital light business, which Facebook, Meta was very capital light, cash generating, and transforming it, transmuting it into a very capital intensive business. The market is okay with that right now because the top lines are growing, but there will come a time where people will look around and say, this is not as capital light as I once thought.
Al Root in the Barron's has a great article out today. I think it'll be in this weekend's edition, where it's dividends versus share buybacks. One P. Sweeney is mental about this. Should they be doing more dividends? Jim Reed over at Deutsche Bank says do more dividends.
Yeah, I mean, as far as a use of capital, we always do like to see dividend raises. The thing we don't like to see, I remember this was really popular back in like 2014 when yields were low. Companies that I covered were borrowing money in order to accelerate dividend growth. Usually a bad idea. But we have seen buybacks. This is a really important point. Buybacks are at a record level and by a material amount. So despite all of the uncertainty that we've had this year, companies are still saying that buying back shares at these valuations is still a good use of capital.